Now, you typically have CFOs at retailers that are not real estate. They don't have a real estate background. They might have a finance, banking, retail operations background. And so
Mhm.
when they look at the financials and the balance sheet, they look and they see, wow, that's a lot of rent that we pay. I'd like us to pay less rent, right? Can you work on that, head of real estate, right? And so a lot of these heads of real estate, they're spending day in, day out trying to figure out, like, how can I pay less rent? Can I do a blend and extend? Can I do some kind of 2-for-1 consolidation? I've got two locations. They're both above average, but maybe they'd be amazing if we consolidated those locations. So they're always trying to do this blocking and tackling. And then at the same time, the CFO also sees a book value for their real estate that is, generalizing here, significantly less than the market value of those assets, right? Because you have, what did I pay for it? What did I invest in having all of the furniture, fixtures, and equipment, right? And then it's depreciating, right? I don't need to get into accounting 101, but essentially the value always goes down. Where if you were going to operate that store for 50, 60 years and you were to sell that income stream of the rent, the value would be higher and higher and higher and higher. So you end up in a situation where, name a large grocery retailer that has a lot of owned, you could say Costco, Walmart, Publix, Kroger, Albertsons, any of them. And if you were to take the market value of what they own in just an open marketplace, it is probably 20 to maybe even 30% of that, enterprise market value is tied up in real estate. But if you look at the book value, it's like peanuts. So you have these you have the situation where from a financial standpoint, you say, I want to pay less rent. And yeah, I own some real estate, but the book value is not that high. And it's not like I'm going to sell it anyway. So it's not an asset I can trade in and out of. But when times are good and you have cash flow, you should invest in owning your forever locations. The sum of the parts analysis, it is significant. If you were to break these things up, you would create more value. But I would say create more value for whom and for how long, right? You go and you sell billions of dollars of Walgreens to fund the core business or to fund a turnaround. You have to, have some significant conviction that that's a turnaround that's going to be successful. And if it's not, well, now not only did you invest, I'm using them as an example, but across the board, when you're choosing to sell those locations to harvest the capital, it is when you are in inherently a challenging environment, because you wouldn't normally do that. And then you are effectively saddling yourself with more long-term debt and debt in a way that is against the functioning of the core business. Because now all of a sudden you have so much more rent obligation and you have such a greater liability against your core business of the stores that you operate. So I prefer when the retailers stick to their core business and making that great. They have traditionally not been great real estate developers. That's not to say that they couldn't be in the future, but when the core business has a strategic, difficulty, you can't fix it through monetizing real estate. You can't fix it. It's just the core business has to be fixed. And if it can't be, then what are you selling? That's the other thing. So traditionally, you would sell the long term rental stream. And so when the market and when the credit indicates that your business has a long term reliable outlook, then you can sell something at a low cap rate, which in turn equates to a high valuation. But the more risky your business becomes, the more the market will respond through your credit rating and through other things by saying, actually, we think that's a lot of risk. And we're not going to give you that low of a cap rate. We're going to keep ratcheting up the cap rate, right? So now all of a sudden, maybe when you could have sold it at a really good cap rate for a really high valuation, you didn't do it because you didn't think maybe I don't really need to sell it right now. Maybe I can wait. And the longer you wait, well, everyone else has figured out, not a lot of secrets, right? Everyone else has figured out your business is also struggling. So now you want to sell it and you thought you could get 3 or 4 billion for it. Now you're getting 1 or 2 billion for it, or, put the zeros wherever you'd like. And so this is where I get back to the day you need to sell your real estate is almost never the right day to sell your real estate. When folks ask me what kind of indicators that I look for, if I only had one, it would be, is this a net out migration location or is it a net in migration location, right? So demography in that way can fix a lot of problems, right? So are people leaving Rochester and are they moving to Houston? Yes. And so if I've got 20
I'm like,
stores in
is this
Rochester
a
and I've
test?
got 20 stores in Houston, maybe I don't need 20 in Rochester. But if I'm not careful, someone else is going to take my market share in Houston if I'm not adding stores in Houston. So certainly people are moving largely north to south and out to the coast and from higher regulatory environments into lower regulatory environments. And how do we make sure that we're creating an environment to be successful as those areas continue to shift? So I would say, in general, the asset classes that have a greater ability to reset rents in line with inflation, tariffs, cost of capital, right? So a hotel gets to reset their rate every night, right? You stay every night, you get a new chance for a new lease. A self storage, maybe it's once a year. An apartment, it's once a year. Industrial, maybe it's a 5 year or a 10-year lease. Maybe there's no options. Maybe there's one option, but a retail lease, if you have a lease with Kroger or you have a lease with CVS, you've got 75 years worth of relatively flat lease term. So I would say in the near term, and I say near term, 25, 26, 27, I think the headwinds for commercial real estate are really strong in a high interest rate environment. I think if we get even just small rate cuts to give an indication that maybe the worst is behind us and people should feel free to get the capital flowing again, I think that would be really good for commercial real estate.
I wanted to kind of jump into a lightning round. And so I'll ask you a series of questions. You can pass if you want, but kind of like whatever comes top of mind. All right. So, number one, most underrated commercial real estate market today,
Asheville, North Carolina.
most overrated market.
Austin, Texas.
Three, flagship store or pop up shop. Which do you prefer?
Ugh, neither. Just make your real store great.
Love it. Four, if you had $1 billion to deploy tomorrow, which asset class gets it first?
Retail,
Five, what retail trend makes you roll your eyes?
pop-up stores and flagships.
Good one. Oh, six, sustainability or convenience. Which wins with consumers today?
Convenience.
Seven, most exciting real estate innovation right now.
The modeling associated with rent in apartments and industrial.
Eight, the last retail space that truly wowed you.
Costco's Issaquah location.
Nine, if commercial real estate were a stock, are you bullish or bearish this year?
Neutral.
Mm. Last one, number 10, one word to describe the future of commercial real estate.
Dynamic.